The government in its final budgetary presentation has announced a limited form of a farm support scheme. They've also announced some tax breaks for the middle class. Is this a consumption-oriented budget, and what will be the impact on the economy? Sajjid Chinoy, Chief India Economist at JP Morgan, and Siddhartha Sanyal, Chief Economist, India Economist at Barclays India, joining us here on this conversation. Thank you both so much for sparing time for us. Sajjid, I'm going to start with you on the bigger message behind the budget. Does this look like it's an attempt to, ensure consumption remains strong in the economy, and in particular targeting some segments which may have been hurting?
Good evening, Ira. No, well, to be fair, I think the government, entered this budget with a kind of unenviable combination of circumstances. Remember, GST collections are kind of undershooting, and will be anywhere close to 20% below what they had budgeted. Number one. Number two, there clearly are pockets of distress in the economy, agriculture, small, medium enterprises. So they were under some pressure to deliver some sort of agricultural package. And number three, you also had the fiscal constraint because bond markets have been nervous all year. So given these constraints, I think they did an admirable balancing act. I think on the agricultural package, it was far more focused and far less expansive than some people had feared. The fact, however, is that there is about 0.5% of GDP in new liabilities, close to 0.4 on the package, and the tax rebate cost 0.1. So to keep the deficit at the same level as next year, we have to generate that 0.5% of GDP, and most of it is coming through pretty aggressive assumptions on tax buoyancy. And that's the big risk next year, that if those tax buoyancy assumptions don't materialize, how will we finance the 0.5%? But I'll just step back here for a second. I think the real story today, again, is not on the budget, it's off the budget. We've been pointing out about this public sector borrowing requirement way of looking at things, and what you will see is Food Corporation for India, for example, last year borrowed 1.3% of GDP off budget from other sources, and this year again have borrowed 1% of GDP off budget. So if that does increase the effective deficit, and if you look at center, state, FCI, other public sector enterprises, the total public sector borrowing requirement is way upwards of 8.5% of GDP last year and this year. That's the number that really matters from a macroeconomic perspective.
And I intended to ask you for greater detail on the numbers, so I will come back to that point, Sajjid, but I do want to get initial thoughts from Siddhartha. Siddhartha, what was the sort of standout for you for the budget, both in terms of announcements or in terms of data points?
No, it's true, the way Sajjid mentioned some of the points, that if you see in this particular in the backdrop of this particular budget, we had a situation where tax revenue collection had been more often than not had been undershooting. GST is still in its initial phase, and we still are waiting for a lot of clarity to emerge. What is the steady state growth path for GST? We still don't know. In that kind of a backdrop, also we have an election in the next few months, as well as several segments in the economy are showing some signs of weakness, as well as the so-called rural distress is actually has been a big chatter. So in that kind of a backdrop, it was not an easy job, and it was this particular fear was there that if they actually try to come out with an income support program, even if it is for a targeted subset, it can be a huge liability for the overall exchequer. But at this juncture, what they have rolled out, about 6,000 rupees for small farmers, that particular cost of about 0.3% or 0.4% of GDP is possibly a lot more manageable. Now, the other point what Sajjid mentioned as well about the tax buoyancy going ahead next year, that also remains a very key point. That at this juncture, we think the budget maths is it's a mixed bag. If I look at the budget maths, they are possibly not very aggressive in terms of their assumption on the direct tax side, and that has been doing well also in the recent past. But the indirect tax side, they are talking about an uptick in the tax revenue, which needs to be seen.
Right.
My sense is that at this moment, the government will be getting the benefit of doubt. But once the final budget comes in, possibly in about 4 months' time, there will be a much closer scrutiny about the tax buoyancy aspect, and people will take a view on whether the 3.4% deficit target for FY20 is achievable or not.
Sure. Sajjid, I'm going to get to the point that you were mentioning, and, firstly, thank you for explaining this to us ahead of the budget. So, if you look at that resources or public enterprises segment, as you said, FCI is where the large pressure is coming from. If you take bonds, debentures, ECBs and others category, they have borrowed in FY19 almost 2 lakh crore, 1.9. And in FY20, it's again very large at 1.8. Exactly right. What's going on here, Sajjid?
That's the puzzle, really, and this is a phenomenon that has started 2 years ago, and it's hard to understand where they're borrowing from. One can only speculate: is it NSS? Are there other sources of financing? But one has to kind of inescapably reach the conclusion that these arrears have been built up for a while, and to the extent that the government doesn't have the fiscal space to pay them as a budgetary allocation, the fact is that it needs to be financed from somewhere, so FCI has to go out and borrow that from somewhere else. And to be fair, we must conceptually disentangle two parts, because when I look at those extra budgetary resources, there are a whole bunch of public sector enterprises, NHAI, REC, PFC, also borrow, and those are perfectly legitimate borrowings because they're typically borrowed to finance capital expenditure. So we don't mean to demean all of that. It's just that there are some entities, Air India, maybe NABARD, maybe FCI, that should really be getting budgetary allocations. And if those budgetary allocations don't materialize and the centre's deficit looks better, these entities borrow somewhere else, and therefore the effective deficit needs to include both components. That's our limited point. The last thing I'll say around this, as we've discussed before, is when we look at a total public sector borrowing requirement of 8.5% of GDP, again, it's not to say that that's excessive. A lot of that does go into capital expenditure. But that is the public sector's claim on household saving. Now, aggregate household saving has come down from 23% to 17%, and net household financial savings in the economy are down to 7%. So in a way, the public sector is borrowing all of the extra net household financial saving and then some. The question is what's left over for private investment. Therefore, this large public sector borrowing requirement matters.
Siddhartha, your perspective on some of these extra budgetary spends, in particular, if you have a thought on the FCI matter. Don't mean to harp on it, but the NSSF data does not show a similar amount being borrowed by FCI. So I don't know if this is bank loans, etc., on account of subsidies being rolled over.
So yeah, you are right that not only this quasi-government entities, even right now we were discussing about the central government. In fact, the state government's borrowing every year in the last few years had also been expanding. So if I actually see there had been continuous reduction in the deficit of the central government, but that benefit has not. I mean, the case for central state government is very different. That's why the consolidated deficit is not really lower. So as a whole, if I see, let's say, from the early 2000s, there had been a very significant drop in India's overall public debt to GDP ratio. But after that, over the course of the last several years, it has been very, very stagnant or moving almost sideways, or may have inched up in a few years a bit. It's still within a narrow range. That's why it's not really causing much of a distress, but it's not going down anymore. Now, that remains an interesting point, because as such, if you see India's nominal GDP growth, which typically grows in double digit, there is a natural ability for this particular economy to gradually reduce its overall debt burden in real terms. But that hasn't really happened over the course of the last several years, which needs to be examined a lot more closely over the course of the next few years, possibly.
Sajjid, going to the point on tax revenues that you mentioned earlier, do you think they are aggressive? I know compared to what we managed to do last year, they seem aggressive, but if you benchmark them to nominal GDP growth, are they looking that aggressive?
Well, parts of it. Again, I don't want to, to be fair, let's give the government some credit. This was a very fine balancing act, and I think they've done the best job they could. But if I were to get into the weeds, so aggregate GST collections in the last 6-7 months have been growing about 7%, definitely below 10%. Now, if I look at CGST collections, I think even the revised estimate number for this year, which is 5 trillion, will be hard to meet given the current run rate. I think this year will end up closer to 4.8 trillion for CGST. And what the government has budgeted for next year is 6 trillion. So that's a 25% growth rate in CGST collections. And let's see if that materializes. The hope, of course, Ira, is that post the election, there'll be meaningful efforts by the next government to tighten compliance. And if you get a compliance tightening that's meaningful, then you will get growth rates that are above nominal GDP. Number one. Number two, if I had to quibble, I would also look at personal income taxes. I think corporate income taxes are fine, their budgeted growth rates. Personal income taxes, to get to this year's revised estimate number, you need a very strong growth rate the next 3 months. And even if you hit that number, next year we're looking at a growth rate of above 20%. Because remember, if you take into account the tax rebates, you need to shave off about 25,000 crores from your starting point. So to go from that new starting point to what the budget asks for next year is a growth rate of above 20%, which is much more than nominal GDP. Now, at some level, this is all academic because, frankly, all of this will be revisited by the new government in the July budget. So it's entirely possible that at that point in time, the new government would have seen the first 3 months and would have said, we need to raise other sources of revenue, and so tax rates could well, be increased for some sections of society to mobilize those resources.
Sure, we will have to go through this exercise again. Siddhartha, on the non-tax revenue front, again, a large reliance both on divestment and on dividends, and within that dividends, RBI dividend quite clearly, both in FY19 and in FY20.
This numbers, given that there has been the expenditure side has been expanding at a relatively rapid pace. I think in case of quite a few pockets, like in GST, even in case of non-tax revenue part, also the assumptions remain to some extent aggressive. Now it depends on how exactly the liquidity scenario, etc., on the part of the in case of the financial sector to determine what is the surplus level for the RBI, what is the global rate of return, etc. So it's not really ruled out, but at the same time, given that on this counts in the last 1-2 years, we have seen occasionally a bit of stretch, a bit of push towards the end of the year to get the disinvestment done. I think in some of the pockets it remains somewhat aggressive. But having said that, I tend to say that these are at the end of the day, though it gets a lot of headlines, at the end of the day, it's relatively smaller sum which we are talking about. The key thing is definitely the run rate which we eventually get to see on the GST side, because it's a much bigger chunk.
Sure, that point is taken. Just last couple of questions. Sajjid, on the expenditure side, I mean, you alluded to this earlier. So, we were talking to Sanjeev Sanyal. They said that they see the farm support scheme as a top-up on top of already subsidies that exist on the agricultural sector. And, of course, they haven't taken away any subsidies. But the point is that the recurring expenses in terms of support to the farm sector is continuing to grow, right?
That's right. And I think, if I can just step back, I'd say, I think we need to at some point just take a more holistic and strategic view. I think our demands on our fiscal are just too many. We want from our fiscal much more public investment. We now want an expanded safety net in the form of cash transfers, pensions. We certainly need much more health and education expenditure to improve human capital. And the point is, we just can't simultaneously accommodate all of these pressures and all of these demands on the fiscal, especially when on the revenue side, you've got much more uncertainty, because like any other GST in the world, this will take a few years to kind of get into steady state mode. And even though you've cut tax rates, these Laffer curves come into play with a lag. So it's only going to be after some time that compliance picks up. So, I fully appreciate the fact that there is a lot of farm distress. And I think the existing subsidy mechanisms clearly aren't effective. And if we can get the cash transfer scheme right, that would serve as an important antidote. But I think if we step back, when the new government takes office and you think of the July budget, we have to re-examine, given this large borrowing requirement of 8.5%, what are the demands we can realistically place on the budget and what things can we move to the private sector?
Siddhartha, last question to you. What did the bond market react to? Was it the gross borrowing number? Was it a disbelief on fiscal numbers? Was it 2 years of fiscal slippage? Or was it some amount of concern that the monetary story may change because of what's happened on the fiscal side?
So basically, in this case, yes, you are right that about a year or say 13, 14 months back, we possibly used to be a little more optimistic in terms of government's intention to very rigidly sticking to their fiscal deficit target. These 2 years we have seen a little bit of slippage, just about 10 basis points, which is very small, nevertheless a slippage. So that really opens up the possibility of further slippage, or the possibility of further slippage goes up to that extent at the margin. Having said that, as I mentioned earlier, that at the moment people will possibly not be thinking too much about the authenticity or the accuracy of some of the forecasts. The first half borrowing calendar will still be prepared on the basis of the current borrowing amount which we are talking about. And I'll not be too surprised if that eventually remains in the form of a relatively even balance between H1 and H2, like the way we have seen in the last year, not necessarily the old formula of very strong front loading in favor of the H1. So we might actually see a bit of support from those factors. In terms of RBI, our sense is that yes, if I think of only economics, yes, the fiscal policy is playing the role of supporting the economy a lot more aggressively at the moment. They're reaching the grassroots level of the economy and spending money. Typically, the consumption propensity at that zone is very, very high. So it offers monetary policy a reason to stay on a slightly more cautious ground. Also, even though inflation number today is around 2.2% kind of a number, we do sense 6-8 months down the line, the number is more in the vicinity of 4.5%. That actually suggests that RBI should stay on hold. And last point is, given that there is a big political risk just in less than 3 months' time, and we have seen in some of the cases earlier, there had been quite significant movement on the currency side, it might not be too imprudent on the part of the RBI to stay slightly cautious at this juncture and actually think of some more easing, etc., if at all, slightly later during the year. Having said that, we recognize that this is a close call in this particular policy because there had been very explicit demands from the political leadership at times in public domain that according to them, the interest rates are too high, there is need for it to come down. But though it's a close call, our baseline expectation is that they actually turn dovish, change the policy stance into neutral, but don't really cut in this policy itself.
All right, we will get to know next week. Sajjid, Siddhartha, thank you so much for taking the time to speak to us on what is undoubtedly a very busy day for everybody. That's a view on some of the interesting data points within the budget. Thanks so much for watching Bloomberg Quint.